U.S. sales of fixed annuities were an estimated $19.4 billion in the second quarter of 2010. That's according to data from the Beacon Research Fixed Annuity Premium Study. Sales were up 18% from the first quarter of 2010. My guest is the Director of Sales and Marketing for Beacon Research, Judith Alexander. Welcome, Judith. Thanks for talking with us.
Thank you for inviting me.
Well, Judith, this is good news for fixed annuities, I'm guessing.
Yes, it is. We were very happy to see both product types do so well, and actually all four fixed annuity product types improved sales from first to second quarter.
Now, how does this compare with 2009?
2009 was one of the strongest quarters on record, so sales were below second quarter of 2009, but it would have been hard to equal those.
Does your study take a look at any of the reasons why this is happening, or does it give any indication?
Well, in 2009, we had a convergence of factors through the first half of the year. First of all, consumers were very risk-averse, which they still are, but they were even more risk-averse back then. And at the time, they were just beginning to tiptoe into corporate bonds. Even corporate bonds were felt to be too risky. So they were buying bank certificates of deposit, treasuries, and fixed annuities. Because really the whole worldwide, everyone was very risk-averse. In order to get anyone to buy their bonds, corporations had to pay a lot in yield in order to entice them to take more risk. And when corporate bond yields are significantly higher than treasury rates, fixed rate annuities have a big advantage over CDs, treasuries, and that kind of thing, because insurance companies buy corporate bonds to back their fixed annuities. So therefore, when there's a big rate advantage, typically sales will really boom. And in fact, in the first half of 2009, demand really did exceed supply for all four fixed annuity product types. And the reason that was the case is that all fixed annuity products are guaranteed. And in order to back those guarantees, insurance companies are required to hold reserves so that they'll be able to fulfill their promises to annuity owners. So during 2009, there was a desire to preserve reserves, if you'll excuse the alliteration. And part of the reason for that was nobody knew how many bonds were going to default, how many mortgages were going to default, and so on and so on. So in other words, the reserves that insurance companies had every reason to think they had suddenly didn't look so secure on paper.
Based on this information in your study and news, for example, that the bond market is actually a big bubble that could burst sometime soon, what does this tell for the future of these products as far as their sales and the rates?
We believe that until the interest rate environment changes, fixed annuities that have a declared rate, in other words, I promise you to pay this much for 5 years, let's say, those kind of products are going to have a hard time because of just what you said. The demand for corporate bonds or actually, I hear from many of our insurance company clients, exceeds supply. Rates are really, really low. And so fixed rate products are going to have a hard time. We think indexed annuities and income annuities are going to continue to do well. But we think that probably those increasing sales won't be enough to provide us with an overall sales increase.
But the rest of the year, you're thinking for indexed annuities, for example, should remain strong?
We believe so, yes.
She is Judith Alexander. She is the Director of Marketing and Sales for Beacon Research. Judith, a great pleasure, and if it's okay, I'd like to call on you again sometime.
Anytime. It's my pleasure, too.
This is Scott Drake, and you're watching Annuity News Now.